So you've been paying into Social Security your entire working life. You retire, start collecting your benefits, and think, finally, I'm getting back what I earned. Then April rolls around, you sit down to do your taxes and find out the IRS is taxing your Social Security payments. This catches nearly half of all retirees completely off guard, with up to 85% of their benefits potentially being subject to taxes. If you're approaching retirement, or maybe you're already there, this video could save you thousands. I'm going to walk you through exactly how Social Security taxation works and show you real examples of how this impacts your taxes and retirement so you can make the most of your Social Security benefit. So let's start with how Social Security taxes currently work. If you're single and earn between $25,000 and $34,000 in retirement, up to 50% of your benefits are subject to taxes. If you're over $34,000, now we're talking up to 85%. If you're married filing jointly, your thresholds are $32,000 to $44,000 for the 50% level, and over $44,000 puts you at up to 85%. Now, I need to clarify something important so this all makes sense moving forward. When we say percent taxable, it doesn't mean that percentage gets taken directly from your Social Security check. It means that percentage now counts as part of your overall taxable income at your regular tax rate. So here's how this actually works. Let's say you get $20,000 per year in Social Security benefits, and you end up in that 85% taxable scenario. 85% of 20,000 is $17,000. Now, that doesn't mean 17,000 gets taken away from you, leaving you with only 3,000. What it means is that 17,000 gets added to your overall taxable income and taxed at whatever tax bracket you fall into. And for the remaining 3,000, that's yours, free and clear. The IRS doesn't even look at it. Next is understanding provisional income. Now, your provisional income determines which of these income thresholds you fall into and tells you exactly how much of your Social Security benefit gets taxed. So, what this chart shows you is pretty simple. The lower your overall income, the less of your Social Security benefit gets included in your taxable income. Now, provisional income can be broken down into three main buckets. The first bucket is your adjusted gross income, excluding Social Security. So, this includes wages, dividends, capital gains, business income, retirement distributions from your pensions, 401ks, 403bs, and traditional IRAs. Basically, this is all your regular taxable income. Bucket two is the interest you'd receive if you own municipal bonds, also known as tax exempt interest. Now, a quick note: Roth IRA distributions don't go here. In fact, Roth distributions don't affect this calculation at all because you already pay taxes on those contributions. And the promise with Roth accounts is they won't be taxed again. At least that's how it stands for right now, and hopefully it stays that way. And finally, bucket three is simply 50% of your Social Security income. So we add all three buckets together and you get your provisional income number. Then you can use this chart to see exactly which tax threshold you fall into. Now, here's what's frustrating. These income tax thresholds were set in 1984, updated once in 1993, and haven't been adjusted for inflation since. So, as prices rise over the decades, a bigger portion of Social Security benefits gets taxed. This means you end up paying more in taxes, even though your actual spending power hasn't increased. Now, sometimes the government adjusts tax rules to keep up with rising prices, but in this case, those thresholds haven't been updated in a very long time. And here's the real kicker: as your income rises, you're getting hit twice. Not only are you moving into higher tax brackets because of the income itself, but you're at the same time pulling more of your Social Security benefit into your taxable income. So every extra dollar you earn in certain ranges pushes you into higher tax brackets while also making more of your Social Security taxable. Now, let's look at an example so I can show you exactly what I mean. Here we have John and Susan Sample, and they are both retired. To keep things simple here, their only income is a $6,000 IRA distribution, and combined, they're collecting $50,000 in Social Security. So let's see how this breaks down in their tax report. So we see their total income and adjusted gross income is only $6,000. After taking the standard deduction, their taxable income drops to zero. And notice over here, Their total Social Security is $50,000, all completely tax free, because their provisional income is the 6,000 plus 50% of their Social Security, totaling 31,000, which stays under that $32,000 threshold for married couples. Now let's see what happens if instead of taking 6,000 from their IRA, they take a $40,000 IRA distribution. Well, suddenly their total income jumps to 63,850, and now 23,850 of their Social Security benefit becomes taxable. So here's the math on how we get to these numbers. Their 40,000 in adjusted gross income plus half of their Social Security brings their provisional income to $65,000. Now that puts them over the $44,000 threshold. So 47% of their Social Security, the 23,850, gets pulled into their taxable income. And if we scroll back up, this is where our adjusted gross income number comes from. The $40,000 IRA distribution plus the 23,850 taxable portion of our Social Security. Then we take our standard deduction, bringing us to our taxable income and total tax, which is shown below within the marginal tax brackets. This is where that double hit I mentioned earlier really shows up. If John and Susan took just one more dollar from their IRA, that dollar gets taxed at 12%. But here's where we get caught. That extra dollar also pulls another 85 cents of Social Security into our taxable income. So $1 withdrawn from your IRA actually creates $1.85 of taxable income. That's why understanding these thresholds is so critical for your retirement tax planning. So that's how Social Security taxes work at the federal level, but for state taxes, that's a whole different story, and it can vary drastically depending on where you live. Now, here's the good news. Most states don't tax Social Security at all, but there are currently 9 states that do tax Social Security benefits in some form, each with their own rules and income thresholds, and some are more generous than others. Now, this landscape is constantly changing. More and more states are choosing to eliminate Social Security taxes entirely. So, depending on when you're watching this video, this number might be different. But as of this recording, the states that currently tax Social Security are listed right here. Now, each of these states has their own income guidelines and tax rules. Some only tax Social Security if you're above certain income levels, while others have entirely different approaches. Now, I can't dive into all of the specifics here since each state is unique and I obviously don't know where you live. But if you're in one of those 9 states, just know that there's more to the story when it comes to factoring this into your retirement planning. But it does go to show that Social Security can actually be one of your most tax efficient income sources. Most states don't tax it, and even at the federal level, at most 85% gets included in your taxable income. But here's where it gets really interesting. Knowing this changes everything about how you should approach your retirement withdrawals. Should you start taking money from your 401k first, your Roth IRA, or maybe even your brokerage account? The order you withdraw from your retirement accounts can save or cost you thousands in taxes, and most retirees get this completely wrong. So, if you want to see exactly how to structure your withdrawals in retirement, check out my next video and I'll show you the optimal withdrawal strategy that works hand in hand with what you just learned about Social Security taxation. So, click here to watch, and I'll see you over there.